Welcome to The Explainer. Today, we're stepping right onto the modern financial battleground. We're diving deep into the absolute reality of the National Stock Exchange. And we're comparing traditional manual trading against the relentless, high-speed execution of algorithms. If you've ever felt like the market is just, moving way faster than you can possibly process, or that strategies that used to work are suddenly failing, well, you're in exactly the right place. We're going to break down what's actually happening behind the screens, why traditional methods are completely under siege, and how a new systematic approach is totally changing the game.
To really wrap our heads around the modern market, imagine you're playing a highly competitive video game. You've played for 10 years, right? You've got the experience, the intuition, the gut feeling of an absolute veteran. But your opponent is using an aimbot. They don't miss, they don't get tired, and they definitely don't feel fear. That is the exact reality of trading manually on the NSE today. On one side, you've got the manual legend, trusting their gut, and on the other, a literal line of code that effortlessly scans all 218 futures and option stocks every single second. It's a completely asymmetric war.
There's a quote that perfectly nails this dynamic. If you're trading manually in 2026, you aren't just fighting the market, you're fighting math. Manual traders today are essentially bringing a sword to a drone fight. When you're up against an institutional system calculating probability, risk, and execution in milliseconds, human intuition is just completely outpaced. But here's the secret we're going to unpack for you today. Those algorithms are actually missing something absolutely vital, and if you understand what that blind spot is, you can actually win. But first, we kind of have to look in the mirror. The manual trader's biggest enemy isn't the market itself, and actually, it isn't even the big institutions. It's something we call biological lag. This is our fundamental human flaw. As the trading day drags on, we get tired. When a position goes against us, we don't just cut it logically, instead we get hopeful. We hold on to a massive losing trade just because we feel like it has to bounce back eventually. Biological lag is that exact moment where human emotion overrides mathematical logic, and frankly, it is the single biggest capital destroyer in the entire market. So how do we usually try to fix this biological lag? Well, we try to buy certainty by completely overloading our screens. We end up creating what I like to call the spaghetti chart. Think of a standard Nifty chart, but it's absolutely buried under 15 overlapping indicators, moving averages, RSIs, Bollinger Bands, the whole shebang. It completely masks the true price action. Manual traders just stare at this mess, paralyzed by conflicting signals, blindly hoping that the price is going to bounce off a 200 EMA just because a squiggly line says it should. Let's be real, more indicators do not equal more profit, they just equal more confusion. And this sets up a stark contrast between human and machine. Think about the human trader. We hesitate. We hope the market turns around. Our ego screams that our initial analysis was right, so we just flat out refuse to take the loss. Now, think about the algorithm. An algorithm doesn't feel anything. It operates on pure, unadulterated logic. It sees the price drop below the exponential moving average, and it executes a simple rule. Price is less than EMA, cut the trade. Boom, done. Zero hesitation, zero ego, zero prayers whispered to the trading gods. Which brings us to a pretty brutal reality. 90%. In the highly competitive arena of the stock market, 90% of manual traders lose money over the long term. Why? Because the machine consistently wins simply by not having a heart to get in the way. It flawlessly executes its edge time and time again, while the human trader bleeds capital through 1,000 tiny, emotion-driven mistakes. Relying purely on manual discretion means you are fighting tooth and nail to be in that top 10%, and you're basically doing it with one hand tied behind your back. But wait a second. If algos are so perfectly mathematical, we really have to ask why they sometimes just spectacularly blow up. And the answer is their fatal flaw: context blindness. Algorithms execute rules without understanding the broader macroeconomic vibe. Take a sudden flash crash on a massive F&O stock, like Reliance, for example. A machine might spot a sharp drop and aggressively short the stock based on a momentum rule, completely unaware that the drop was just a temporary data glitch or a totally irrelevant news headline. The algos start cascading, triggering each other, and boom, you get a flash crash, all because they can't read the context of the real world. Because of this context blindness, smart human money knows exactly how to exploit the machine. We call these operator traps, or SL hunting. Imagine a clean chart with a massive fake-out wick. A machine simply sees a technical crossover, buys in, and sets its stop-loss at a highly predictable mathematical level. Well, big institutional operators know exactly where those algorithmic and retail stop-losses are clustered, so they push the price down just enough to trigger that massive pool of stops, creating that shark wick before driving the price right back up in the original direction. The algo blindly follows a rule and gets eaten alive by someone who actually sees the bigger picture. Let's break down these algorithmic blind spots a bit further. A line of code has absolutely no idea that it's budget day in India, where volatility can whip back and forth violently in a matter of seconds. It doesn't know that the RBI governor just stepped up to a podium to drop an unexpected speech about interest rates. And it definitely cannot measure overall human fear, panic, or the underlying vibe of the market. These are qualitative, distinctly human contexts that drive massive moves, and a pure math equation is going to miss them every single time. So we're left with this core debate in trading today: indicators versus experience. Indicators, by definition, are just calculated history. They take past data, output a visual, and tell you exactly what happened. Experience, on the other hand, is the ability to anticipate the likely future. It's looking at the market and understanding the why behind a move, not just the what. It's spotting an operator trap forming in real time, or sensing that the market is just shrugging off bad news, which, by the way, is a massively bullish signal that no moving average can ever quantify for you.
You see, we're caught between two extremes here, and neither is perfect. If you rely 100% on a green arrow appearing on a chart, you're a slave to an equation that completely lacks real-world context. You'll just get chopped up in volatile markets. But if you swing the totally opposite way and rely 100% on your gut feeling, you become a slave to your own emotions, falling right back into that biological lag. You'll hold losers way too long and cut your winners way too early. We desperately need a bridge between the two.
Section 3. The systematic era, bridging the gap. All right, so here is the ultimate solution. Welcome to the systematic era. This is where we synthesize the absolute best of both worlds. We're taking the flawless execution and discipline of the machine and combining it with a contextual awareness of the human. Think of this new systematic approach as stepping into the cockpit. We are completely throwing out that chaotic, messy spaghetti chart. Instead, a systematic trader uses a clean, professional dashboard. Just like a pilot flying a commercial jet, you have exactly the instruments you need, no more, no less. The data is clear, contextual, and designed for rapid, objective decisions. You're not guessing what the squiggly lines mean anymore. You're reading clear parameters that tell you the state of the market, letting you execute flawlessly. So what does this actually look like in practice? Well, there are three main pillars to systematic trading. First, we take proven manual strategies, but we execute them with the cold, hard discipline of an algorithm. Second, we use automation, but, and this is key, we refine the code so it respects human market context, like, hard coding it to turn off on budget day. And third, continuous stress testing. We don't just build a system and cross our fingers. We actively try to break it to find the failure points before the live market does. To prove exactly how powerful the setup is, we are currently deep diving into stress testing this exact systematic cockpit. We're running the numbers, looking at the raw historical data, and intentionally hunting for the breaks. Because look, before we can build a robust system that consistently wins, we really need to understand the raw reality of exactly why systems and people lose. We're leaving the magic indicator fairy tales behind, focusing purely on hard evidence, and actively trying to break the system so we know for sure it's battle-tested. As we wrap up this explainer and gear up to build a highly effective, systematic framework from scratch, I want to leave you with a really crucial question. I want you to reflect on your own trading journey and drop your answer down in the comments. What is truly holding you back right now? Is it your emotions, that biological lag making you hesitate and hope? Or is it your entries, the lack of a clear, mathematically sound edge? Let's get the discussion going down below. Thank you so much for joining me to explore this algorithmic war, and I'll see you in the next explainer.